Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us for this segment, we have Kevin Davitt, Head of Index Options Content at NASDAQ, and Brett Friedman, Winhall Risk Analytics and OptionMetrics Contributor. They join us to discuss trends in implied volatility. It is great to have the both of you with us. Brett, we'll kick it off with you. Question is, bubbles. Are they easier to identify in retrospect than they are in real time? And what methods do you use to try and identify them?
This became an issue about a month ago when the market was laser focused on Nvidia, where every single day it was going up. And naturally, some people started wondering whether this was a bubble or not. I'm an options person, so I view the markets from an implied volatility standpoint. Everything to me is implied volatility. Implied volatility is a forward measure, and it measures an uncertainty, anxiety, as it were. And so I decided to look at certain metrics around implied volatility, mostly the trend of implied volatility, as you can see in the chart below. My conclusion was that no, it was not a bubble. Implied volatility was not acting the way you would think it would in a bubble type situation. Rather, Nvidia's implied volatility was mostly reacting to earnings calls, that it would spike before the earnings call as there was uncertainty as to what was going to go on in the call. And then afterwards it would crash down regardless, and one of the earnings calls was very positive on the upside. And you actually saw implied volatility come down. The reason being that the uncertainty was gone. And so, everybody was like happy again. If the opposite had happened, implied volatility would have gone up. But to me, it was an orderly market. It didn't have the hallmark of the frantic, anxious trading action that a true bubble would have. As well, the risk premiums, the skew, nothing was saying that this was anything other than just an aggressive bull market in a single stock. Not everything has to be a bubble.
Yeah. And Kevin, can you use the same type of implied volatility measures when you're looking at indexes or more broader sectors?
I think you most certainly can. And I think many in the marketplace and probably a number of the clients that Brett services do look at the world that way. So like Brett, I do apply sort of a similar lens in that implied volatility is kind of everything, but through the lens of index options. Speaking to sort of the time frame that he referenced, the trend in implied volatility almost across indices over the past month has been lower. So giving that a little bit more context, the NASDAQ 100, the index that I am looking to help grow, the 1 month at the money forward vol is very near the lowest levels in 2 years. The 30-day at the money options are trading on about a 14% volatility, and 13.5% is essentially the lowest we've seen since COVID. One of the stickier forward vol measures has been in the interest rate world. So the MOVE index is typically referenced there, and even that has fallen below 100 recently. Now, relative to the longer term history of the MOVE index, that's still high, but it's lower than it's been in quite some time. So we're seeing rates vol expectations easing as well. I also can't help but think about the time we're at in the year. And generally speaking, I'm not advocating for any positioning around this, but volatility does tend to decline in the summer months and pick up around August. And that's particularly the case during an election year like we have now. The options market have been pricing in the potential for greater volatility around November for months now. It's a known unknown. And to Brett's last point, I think it is so much more difficult to identify real complacency or relative lows in the forward vol market in the moment than it is to identify panic. Panic situations are much clearer, despite not knowing how or why they might end. So I am certainly apprehensive to allude to any type of bubble. What we have observed has been very orderly markets, and generally they have moved higher for the better part of the past 7 months.
They certainly have. And Brett, when you're taking a look at option skew, would you consider that an indicative indicator as well?
I mean, you can use option skew as sort of an overbought, oversold index, and it's important to define exactly what you mean by option skew. I mean, there's two different types. There's put versus call, call versus put, and then there's out of the money to at the money volatility spreads. I'm talking about the latter mostly, because when in bubbles, retail investors tend to go into deep out of the money options because they're cheap. They want to get onto this onto the market as cheaply as possible, so they buy deep out of the money options because they think they're cheap. In implied volatility terms, they're incredibly expensive, so they start bidding them up, and that's usually the sign of a bubble that's in formation, that the out of the money to at the money skews become historically very, very high. And I didn't see that with Nvidia. The skews look more or less normal to me. But that being said, I've seen markets going back to the point where it's more easy to determine panic than it is just a regular old market. I've seen skews that are blown out for a long time, that they're very high levels, and the market continues to move along. It doesn't turn around. People are just paying a lot of money for this thing for whatever reason. So it's kind of like when I'm looking for a bubble, I'm not looking at one metric. I'm looking at a whole suite of them. I'm not just driving my car by just looking at the temperature gauge. I'm looking at a lot of stuff to determine what's going on.
And Kevin, let's put this in the context of the NASDAQ 100, if you can give us an example.
Sure. So I think it's interesting to see the level of attention that skew has gotten broadly over the past couple of years. I think that's wonderful because it's indicative of the broader market placing an increasing amount of value on option-based metrics. There's a whole lot of information. These are information-rich products, whether you use that to affect positioning or not. And depending on the time frame that you're looking at, we have seen unusually steep call skew, and in some situations, very positive call skew in a handful of single names. Some of the ones that lead in the NASDAQ 100 at different points this year. Now, the name Brett focusing on Nvidia, I believe, have earnings next week. And here and now, on the call skew there, it is much flatter than it was in advance of their previous release. What that says about the future remains to be seen, but the market is not reacting in the way he described at the outset. And so I think that's a good example of how that dynamic has shifted in the individual options as well as the broader index level. One way to look, Brett referenced a couple. One way is to look at index option skew. And one of the ways that I am typically going at it is looking at the 25 delta put relative to the 25 delta call. And when you do that on an index level, you're comparing kind of the relative cost and volatility terms of protection versus upside exposure. And there's a relative range that we've seen in the NASDAQ 100 over the past couple of years. Skew is at the low end of that range right now, but not the lows. And so the sort of narrowness of volatility premium between the puts and calls right now are fairly understandable given the fact that we've just come out of what I would consider the crux of earnings season, and we're moving into a period of very few uncertainties, like Brett mentioned at the beginning.
Yeah. And Brett, if you look at the difference between implied vol and historical vol, what can you learn from that?
I'm going to say a controversial answer. Not much. Implied volatility is a forward measure. Historical vol is the standard deviation of whatever bunch of days you want to do in the past. I've tried, but one is a past measure and one is a forward measure. The historical volatility is certainly an indicative of where the implied volatility should be, but it's not necessarily indicative of the trend of implied volatility. And I've tried trading that spread often as to trying to predict what is going to happen with implied volatility based on historical volatility. And it's very, very difficult. To me, a much better way to determine implied volatility is I use my experience as a market maker in foreign exchange options. That people think that when a market maker makes a quote in an option, they have like one option in their book. We have multiple options in a single book, and we're hedging those options all the time. So generally, how much is implied volatility? It's my cost to hedge off my book. So if the market is extremely volatile and is a pain in the neck intraday, I'm going to start charging more for implied volatility because my costs are going up. My hedging cost is going up. It's difficult. Whereas if I can predict basically this market is a one-way market like Nvidia, it's not that difficult to hedge. I can deal with this. So therefore, I'm going to start lowering implied volatility. So, that's how I view implied volatility, the difficulty to hedge my costs, not necessarily what happened yesterday, but I'm looking forward, not backward all the time.
Yeah, well, I think it makes sense when you're trading options to think like a market maker. It's almost like playing chess versus checkers in my mind. So
Exactly.
Kevin, to wrap it up here, let's talk about it with another visual: equity earning yield versus real bond yield.
Sure. So this what many people describe as the equity risk premium has gotten considerable attention recently. What you're looking at is the S&P 500 earnings yield less the real bond yield. And you can see that the equity risk premium is narrower than what we've seen in arguably a couple decades. There's also clearly a rapid decline in that relationship since the Fed started hiking and bond yields increased. Bigger picture, though, it seems like earnings remain strong relative to history. And we just saw that with many of the names reporting in Q1. But bond yields are much more compelling, certainly much more compelling than they were 2 years ago. So the question, again, like Brett, looking forward, can equities continue to advance against that backdrop? I would say anything is possible, absolutely. There's also risk on the downside. Would it be easier if rates fell, which many continue to expect a little bit later on this year? Potentially. So by most measures, again, the economy appears strong, and the fact that the equity risk premium measure is the lowest it's been in about 20 years is largely a function of real rates moving higher as opposed to earnings and the economy weakening. At least that's the lens that I look at it through. Other things that, if you're inclined to be concerned, the longest inversion in the 10-year versus 2-year yield curve is a potential pausing point. And I'm by no stretch of the imagination a fixed income expert, but that is something that is potentially concerning. It typically alludes to a recession. And then the last thing that I look at in the fixed income world is the OAS spreads, the option adjusted spreads. Those remain quite low or narrow. And essentially that tells you the rate differential or yield premium in the high yield market relative to investment grade. Bigger picture, there doesn't seem to be a whole lot of stress right now in US fixed income markets.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.